This is the Business Stuff Podcast. This is where I will share the lessons I've learned from advising thousands of businesses over almost 30 years. Each episode will give you practical insight to allow you to learn from other people's mistakes. I'll be pulling in experts from our team and the world of business, and together we'll make sure your business is giving you what you want. My name is Martin, and this is the Business Stuff Podcast.
Hello, it's Jack from the Accelerate team, not Martin. Martin's decided to take a week off, so he's left me in charge for a week, so let's see what happens. But anyway, I'm here, I'm joined by Andrea from our Audit and Assurance department. Hello, Andrea. You alright?
Jack, I'm good, thanks, how are you?
Good, yeah. You seem to be really excited about having one of these posh microphones on for the first time.
Buzzing. It's definitely the first time that'll have gone really loud as well.
So you've just deafened our audience, but yeah, it's fine. Don't worry, I'm sure they'll forgive you. So we're going to talk a little bit about auditing, aren't we?
We are indeed.
It's one of those areas where, I don't know, there seems to be this misconception. People assume it's boring to start off with, which I think is actually quite unfair.
Yeah.
But there's also a lot of misconceptions as well about auditing,
Mm-hmm.
which we'll probably get onto later on. But to start off with, why don't you just tell us a little bit about yourself, a little bit about the Audit and Assurance department, and kind of what you guys do over there.
Yeah, so I'm Andrea Simmons. I've been an auditor for 9 years now, so quite a long time. So of that time, I've been at Robson Laidler for almost 4 years now, 2 years as an audit manager. And my job is to do both accounts preparation, like manage the projects, audit, as well as bits of tax and things like that as well. So I'm kind of like a key contact with the clients to liaise, but also manage like the teams who are working on all the jobs. And our department here is, there's about 15 people in Jesmond maybe, and we've got similar kind of team over in Chesley Street as well, so it's quite a big department at Robson Laidler.
Certainly sneaked up in size from the last time I checked.
Yeah,
but that's great to hear. And so you kind of, as you said, it's kind of a mix of kind of general accounting, accounts preparation, and this auditing as well.
Mm-hmm.
So there are lots of different types of audits out there, you know, both non-financial and financial ones, and even within the financial side there's probably quite a lot which you know, some of them might confuse people. So if we're going to say purely we do statutory audit, like what is a statutory audit to start off with?
So a statutory audit, a lot of companies need this because they've breached like medium-sized company thresholds. I'm not going to go into the exact detail, but
they should know though.
They should know though. It's on. You can find it on the internet, on Google.
Yeah.
But basically, the purpose of an audit is to kind of reassure users of the financial statements that the company's accounts are like a true and fair view of that business's performance in the year.
Mm-hmm.
So we kind of we'll go through all the different sections of the accounts, so things like fixed assets, debtors, cash, and we do what's like sample testing or analytical reviews on those. So what's like a very general misconception of an audit is that we, as auditors, look at absolutely every single transaction that a business has done in the year. So that's like not realistic, because if you think of like a big company that could have had, say like a bar company that could have literally sold millions of drinks and had separate transactions like per day and stuff like in the till. So we couldn't verify every single one of those transactions.
We're not ticking off every single receipt from.
We've got to basically decide what's risky and what's not risky, but also come up what we think would be a material figure that would, if it was wrong by that amount, would like impact the user's view of those statements.
Mm-hmm.
So we would use that to then pick a sample and test, and so we'll get an idea if we think that section of the accounts is like reasonably accurate based on our sample testing and looking at some analytical reviews.
So if we put it into a nutshell, basically this true and fair view, as you said, which is a very important term in auditing, isn't it? That basically the accounts look reasonable and they're not completely fabricated.
Yeah, like they haven't just plucked figures from the sky and it's, you know, millions and millions of pounds out. Although for some companies, I mean, they're probably not the size of companies that we would deal with, but some of the larger audit firms might be looking at a, I don't know, £1 billion client, and they might have an error of say £1 million, and that would be all right for them based on their materiality, but we would never come across a business that size.
Yeah, I mean that's the scary thing when you're thinking about that. £1 million is a lot of money for anyone, but then when you suddenly that's actually a tolerable error when you're actually looking at
exactly. So if there's an error of like say 500 grand, we wouldn't the auditors wouldn't make an issue of it. Whereas obviously someone who would look at it as like a normal customer, you think, oh, that's loads of money.
Oh yeah, totally, yeah. So we kind of touched on that there are certain like thresholds that if you exceed in terms of your size of your turnover, your balance sheet, your employees, you have to, under company law, you have to have an audit. But there'll be other scenarios, wouldn't there, where people might want to have an audit?
Yeah, so some people like to have an audit just for like their own peace of mind, to know that their staff are actually like, you know, doing things correctly and that they're employing the correct finance people. Also for loans, like a lot of like big banks, like say like HSBC, Barclays, etc. If they're going to provide a big loan to one of our clients, a lot of the time they'll want as like a condition of that it's been audited. That just gives them the peace of mind as well, that like the forecasting information that the client's given the banks is again like true and fair to the best of like their knowledge.
Yeah, so and obviously that might be the case with grant funding as well, perhaps, and you know, even if there's some angel investors out there, they might want that as well. So that's interesting. So we kind of touched on it a little bit there, but about misconceptions, and where you said that people assume that you look at every single transaction, and therefore when stuff comes out in the wash, and they generally blame the auditor. Are there any other kind of misconceptions that you've come across while you've been auditing?
That's boring. A lot of people think accountants are boring, but we're really not. I think you'll find that it's quite an interesting job in the sense that you're getting to know lots of like different companies and how the businesses work, and it's not just like the same thing every day. You know, there's some kind of tasks you do that you learn a lot more about business than you really think about. Like I think I once did something called a fixed asset verification, which is where you go into say like a client's factory, and you have to like check that say a bit of equipment is actually there and it's being used. I did that once and I got like told about the whole manufacturing process and generally bits about the business that you would never ever know otherwise. And so it is actually quite interesting. It's not just like you sit there and just tick things away.
Yeah, as a curious person, it's always quite fascinating, isn't it?
Yeah.
I mean, I've also an auditing background, for those who are surprised to realise that. And yeah, I can certainly testify that it's one of the most interesting places. It's one of those places that you can learn a lot very quickly. You can learn good practices, how good businesses run, how bad businesses are run, and it's generally around their controls, you know, and how they operate. And it's a really interesting place, and there's no surprise that, you know, a lot of the top financial leaders out there, you know, generally come from accountancy, and a lot of those come from auditing backgrounds as well, don't they?
Yeah.
Are there any other misconceptions that you can think of? I mean, I certainly can think of, again, we slightly touched on it, is that if there's something wrong with the accounts and it's not picked up by the auditor, it's always the auditor's fault. But as you said, that's not always the case, is it?
Yeah, so again, if there's something kind of immaterial that we've not picked up, then you know, it'll be because it's immaterial, so we wouldn't have like found it for that reason. Sometimes we might find an error that's not material in the sense that we would demand it was like corrected, but there's like we have like another threshold which is called like triviality, and so that's just, it's like big enough that we would alert management about it and just say, look, you know, we think this is incorrect. We recommend that you fix them, basically, but at the end of the day, for those ones, it's like management's decision as to whether or not they get corrected. So we might have flagged a difference, but it wouldn't modify like an audit opinion unless it breached our overall materiality level. So
again, just so I can get my head around this, is we've basically got two numbers. We've got the materiality level, which is the figure where if you exceed that, either as an individual error or potentially a combination of lots of errors. If it goes over that number, so say if it was £500,000, if there was £501,000 worth of errors that you picked up on, that's when you would actually have to change the accounts.
Yeah, and if they didn't change it, then that would then lead to like a modified audit opinion, which would then obviously have quite big consequences for the client.
Yeah, and we'll definitely get onto that. And then obviously that second then is the triviality, which is very small errors, which won't really affect the, as you said, the investment decision behind those accounts, and they don't really need to be adjusted for. So maybe a rounding error, for example, for a few quid, something like that, which again we shouldn't really get too hung up on. Yeah,
and say like triviality was like 10 grand, anything less than that we wouldn't entertain. But anything in between those two levels, it's just good practice for clients to be adjusting it, because it then just means that they show interest in their accounts and that they want them to be right. But equally, sometimes the benefits are like outweighed by the cost of processing an adjustment for something that's quite small, which is often a reason why some clients may not choose to post those adjustments.
But even then, I imagine it's probably quite an alien concept for people listening, going like, oh, so there can be a £10,000 error in the accounts, and you don't change it? You don't have to change it? It's strange, but again, I imagine that's another misconception that people really...
But then for some clients, 10,000 would be a material amount for us.
Yeah.
Then it would need to be changed.
Yeah, that's true. It's a good point, because
we do some small clients as well. So it really just depends on the size of the business, and also like how risky we think the industry and things are. There's quite a lot of factors that go into it.
Yeah, that's worth reaffirming that. I say, the corner shop around the street's not going to have a materiality of millions of pounds. When he's
probably close to £1,000 or something like that.
Exactly, yeah. So, I suppose another question to ask then, just off the back of that, is obviously auditing is a specialist area within the accountancy firm or the accountancy industry. So, who actually can do it? Presumably, like the bookkeeper you use around the corner may not necessarily be able to do audits.
So I would say first of all, it has to be someone external to the business. Like a lot of businesses have internal audit teams, which is like slightly different, and that'll just like review, like they might do like a little like a similar kind of process, but like an internal version. But also they might just review things like the risk registers and how the processes are going.
Yeah. But
they're like paid by the staff. It's a bit different. So then an external auditor would have to be, like I say, someone from the business removed, like an impartial third party. So I would usually say it would have to be like an accountancy firm or someone that's like qualified. The firm would have to have like a status with like an accountancy body.
Yeah, so they'll be registered with one of the
so that they're like bodies, trustworthy, and it's someone who's like got the accreditation. I can't say that.
Accreditation. Something like that, yeah.
To be able to carry out an audit, yeah.
And obviously it's not necessarily a given, though. There's obviously been a lot of stuff in the news over the past few years about auditors and when stuff goes wrong. And I suppose it's worth to reaffirm the point that you should really kind of do your research into individual firms and kind of their auditing history. I mean, I suppose you have some Big Four experience, don't you? But they're generally always in the headlines for doing something nefarious or...
Yeah, I think realistically...
I'm not asking you to spill the beans.
No. I did 5 years at a Big Four firm, so I understand. Like, it's one of those ones. I think they obviously get quite a lot of bad press because they're the big names.
Doing the big jobs.
And so, like, it's not necessarily a case that there's a correlation between the big jobs and something that's sketchy, but it's something that's probably more likely to get in the press. But it kind of a lot of the time it does come down to the misconceptions I said before in terms of like materiality and things like that. But then, audit firms can still make mistakes, and sometimes if something's missed, then obviously the firm would then be penalised for that as well, not just the client. And I think that's like the fair kind of process to make sure that the audit industry like remains like credible.
Definitely, yeah, and I feel like it's almost kind of the proportion of the bad auditors to good auditors is a lot lower than people may think, because again, only the bad stuff gets reported.
Well, exactly. It does give us a bad name, but at the end of the day, the amount of actual audits that are like go wrong in that sense are like very small proportion of all. It's the same with anything. If anyone has like a complaint, you hear more about complaints than like positive things.
Yeah, absolutely.
And that's just, I guess, how it is, but that's what ends up getting into the press.
Yeah. So if we have a listener on who's maybe preparing, maybe they've hit these thresholds, or their manager, the boss has turned around and said, we're going to get an audit this year. What advice have you got for them in terms of getting ready for an audit?
So what I would always say is to prepare a year-end file where possible. Now, if you've got like a trial balance ready for year-end, that's what we would ask for as the first instance, and then that's what we would then look to see, like breakdowns of all those kind of balances. So if you've got, for instance, just as like an example of a section, say you've got like your debtors section, within that you're going to have an amount that's owed to you, owed from your trade debtors at year end. Say that's 100 grand, we're going to want like to see something that shows that 100 grand. It's often like an age debtors report that comes off your software, but essentially just breakdowns of all your key balance sheet balances. And then for anything like profit and loss transactional wise, just have like files of invoices like available ready, because when we do a sample test, we're going to need to see things like invoices and also just, I guess, when it comes to booking down the time for an audit, which is it can be a site visit, sometimes not, because of, since COVID and remote working. I guess just have the time to sit and maybe like go through the controls and processes with whoever the audit team is, because we'll want to know exactly how the business works.
Mm-hmm. No, absolutely. So what we're saying there is good third-party evidence where possible.
Yeah.
Because ultimately we need to prove that those balances exist,
Mm-hmm.
or are complete or whatever. We won't get too much into the technical
the assertions.
the technical audit language. Obviously ensuring that all your systems are up to date and processes. And obviously all of the supporting information behind that. As you said, we're not going to test every transaction, but we still are going to be testing some of them, so we're going to need that key data like invoices, as you said.
Yeah.
Potentially some sales orders, purchase orders, stuff like that.
And to some degree you can preempt some of it. If you've got like fixed assets and you've got some additions, 9 times out of 10 we're going to test the big ones. There's obviously going to be, as part of a sample, we'll pick some random ones, but there'll be some that we'll have to test based on size. So I would almost always have your biggest invoice just like ready to go, because that's 9 times out of 10 going to be asked for.
Yeah. And again, you touched on timings there. Auditing can be quite a long process.
Yeah. So
it's more than, you may go out for say a week or 2 weeks and stuff. Like, just because you've gone out and done those 2 weeks worth of work doesn't mean the audit's done. There's obviously stuff happening in the background, isn't there? It's quite a long-winded process, because you have to be very deliberate about these things, don't you?
Yeah. So the general process of an audit is, we would reach out to the client and say, would like some information. Once we've agreed what dates we're going to go out on site, for instance, we'll send a list of information that we need. The idea is that the client would have that all prepared, ready for when we go out on site, bar any samples that would then be follow-up samples. We would try and go through all of that on site. Hopefully everything's available, ready to go. Take everything in, find out, have conversations with the client, get all the answers and understanding as to why things have moved, just generally how the business has performed in the year, so that we can make sure everything's in line with what we would expect. All the site work would hopefully be done in those weeks. Then there'll be a follow-up process if there's anything that we hadn't received on site that was still needed. And then there's a review process. So as a manager, that's kind of a lot of the time where I come in, and I'll make sure that the work done by my team is all up to scratch, and it all makes sense to me what's happened in the year. Mm-hmm. And then sometimes there'll be queries that'll come out of that, which might mean having to go back to the client to get more detailed understanding behind things. And then it goes to the next partner review, and then obviously we usually have a meeting with the client to kind of go through what we think they could improve on, what went well. We like to kind of give them some financial insights from their data, which is always quite a nice touch.
Mm-hmm.
And then we'd report to them any errors and things that we think need to be corrected.
Yeah, it's important, obviously, getting that feedback to make sure that next year it's not a recurring issue.
Yeah. And
obviously that's easier said than done, because sometimes some of these things are very much entrenched in clients' kind of ways they do things, but it's important that we obviously provide that feedback, don't we? Mm-hmm. So again, we kind of touched on it a little bit earlier, but what are the consequences if there is there's a material error, and you report that to the client, and they say we're not going to change it because we disagree? What happens then? What is the process?
So what would happen then is, if they refuse to make a material correction, is we have to then modify the audit opinion. So normally a clean audit opinion, or unmodified, would basically say that we believe everything's true and fair, they've given us all the information that we've asked for, and that there's no material uncertainties about things that go in concern, or there's no big errors, essentially. Mm-hmm. It's a big standard word. And
obviously, just to quickly touch on that, going concern is obviously something when a business can guarantee trade for the next 12 months, is it?
Yes. Yeah. So if for any reason it's looking unlikely that a business is not going to continue within the next 12 months, say they think might default on a loan or something like that, then we have to disclose that in the statements, because it means that the value of the business isn't quite represented correctly, because things will all be worth a lot less if you had to fire sale assets and things like that. Yeah. So that's quite a key part that factors into the audit opinion. But so if we had to modify an opinion, it essentially says that we don't think it's true and fair. There is something wrong. It could be that we've just highlighted a matter, so we've said an emphasis. It's something called an emphasis of matter. Mm-hmm. So there'll be something specific that stands out that isn't right, but everything else we're happy with. But if it's a full like modified opinion, then it has a lot of implications for the client, because anyone who's reading those statements, especially like investors or banks, they're probably going to think about pulling their money out of the business, because it just suggests that it's lies. Basically, there's something fundamentally wrong with the accounts.
Yeah, I mean, I suppose it's they're kind of asking, the alarm bells are ringing for them, won't they? Because it'll just be, well, why would you change that number?
Yeah.
And if this number's not right, then how can I be sure that all of these other numbers are necessarily right?
Yeah, it spirals essentially. It's like, oh well, yeah, as you say, it could mean that there's a bigger problem elsewhere, and also like just the attitude of management. That's like not a great sign if they're not willing to want to show their accounts in a fair way. So yeah, it could, it could have a lot of knock-on effects, but it could ultimately mean that they would lose their investors and funding, and they might have to go out of business as a result. That's quite an extreme, but it can happen.
Yeah. And obviously the easiest way for a company to get around that would be to try and strong-arm their auditors and get them to basically unmodify their audit opinion. So, but there are obviously pretty punitive sanctions in place for auditors, aren't there, if they do find to be falsely reporting on this stuff?
Yeah, well, like this is kind of where it leads into the press kind of thing. Sometimes it is a case where we've just missed something, but not a lot of time, but some of the big cases that's happened in the past, the big four like that have been involved have been fined, substantially for their errors, but also like the RI, which is like the responsible individuals, that's usually a partner or director, might end up either getting their professional qualification withdrawn, penalties. It's very serious, yeah, so you can no longer be director, so it does have like a big impact on the key individual who's involved in the audit.
And just touching on the some of the high profile press that's happened is generally when stuff's gone wrong, especially with some of the big four stuff, it's generally because they're being mixed up in some ethical issues, because there are some pretty important ethical considerations when doing auditing, isn't there? And mainly around kind of self-review and management threats and stuff like that, because a lot of these big fours have been involved in kind of consultancy stuff on the side of doing the audit, which kind of affects their ability to be impartial. Is that fair to say?
Yeah, there's sometimes instances where on a lot of clients you might find that you do other services for them, not just audit. There's like rules in place that suggest that the amount of fees that you're getting from your non-audit services can't be a certain percentage of like your audit fees, otherwise it can like threaten your independence. Because the idea is if you say, like you say, you proposed an error to them and they said, well, no, I'm not changing it, and if you don't give me a clean audit opinion, then I'm going to pull all the other accounting services. If that fee's big enough, then it might then sway the auditor to think, all right, fine, yeah, and that's obviously like a breach of like ethical standards, and that would be the kind of thing that would result in fines and penalties.
And similarly, if you were involved in preparing those accounts to start with, and you uncovered an error, you were like, oh, I don't think I really want to tell them about that one because that's our fault.
So what often happens is you have like different teams, and then there's like a segregation of duties almost in the audit team, and it's like walls, like fictitious walls in between, so that it's different reviewers, and so that it's not the same person who has prepared the accounts who's then like audited them and then reviewed them. And it just means that like limits that happening, and there's various other safeguards and stuff in place as well. Like you can't have like worked like worked with a client within a couple of years beforehand of being an auditors, because it's like familiarity. So there's like lots of safeguards in place for that. For like if a good auditor, their processes will include those, and then the client is always like made aware of those as part of like compliance reasons, so that they know that like from an ethical point of view that the auditor is like acting in the best interests.
Because even we do, and we're working at a relatively low level compared to some of the big boys, but we still have to put in safeguards for basic stuff like preparing their corporation tax alongside the audit, or actually even formatting the accounts into kind of their statutory format, don't we? So it's there's a lot of considerations. It's not as straightforward as a lot of people think. Well, I suppose the last question I had for you was, I suppose, what advice would you have for someone who's aware of audits, who are thinking, do I need one? I mean, what are the thresholds? Am I about to imminently exceed them? Do I need to start doing some forward planning? Kind of what advice would you have for them?
So I would make yourself aware of the thresholds, first of all. I think if you think you're going to breach it within the next 12 months, you have got a bit of time, because the way it works is you have to breach the thresholds 2 years in a row to have your first audit. So it means that if you breach it 1 year, you've got, like I say, time to kind of think about, you know, am I going to need an audit? Like, am I going to breach it again the second year in a row? And then start speaking to different firms. And like I say, it's, you know, people think of the big four initially. That's obviously what comes to mind because of the press. But there's loads of firms out there, like we are, for instance, like, you know, we service companies of all different sizes. It's not just like tiny firms, we'll have really big ones as well. So we do have a very big mixture of clients, and I think it's mostly just kind of shopping around to try and find an auditor who, you know, meets the kind of service that you want. You know, or you want one that's just very compliance, get it done, don't like get involved with you the rest of the year. Whereas some like accounting firms like us, we kind of like check in with our clients and just, you know, make sure things are going all right and touch base and, you know, provide other services. And I guess also just see what your fee expectations and stuff are, and just like
I suppose that's one thing, is it's not necessarily a cheap exercise compared to, particularly if you don't need to have one. But you can justify the value in it, because, as you said, it gives that peace of mind, doesn't it?
And again, think about future financing as well. So if you are going to go to a big bank, there is a good chance they're going to ask you for an audit. So if you're already doing it anyway, then it just saves having to like last minute flap around to try and get something in place.
Yeah, it puts you in their good books. Might give you some good grace when you're trying to negotiate those interest rates, maybe. Perfect. Well, thank you very much, Andrea.
Thank you.
I really hope that you guys got some interest off that. As I said, audit can be a bit of a dry subject, but I think Andrea's done a very good job at explaining it in something slightly more interesting than, you know, reading it off one of the handbooks. Obviously, if you've got any questions about auditing, feel free to reach out to Andrea. We'll have all the details in the details below, and we'll catch you on the next one.
Okay, thank you.